Thank
We're
you.
moving on to our next session now, and Will Lucken, who's Global Head of Product, is going to be moderating this one, looking at why portfolio constructions matter more than ever this year. Over to you, Will.
Thank you very much, Lucy, and good morning and good afternoon, everyone. So yes, thanks, Lucy. As you said, today we're going to talk about the Portfolio Construction and Strategy Group, and I have with me here today Adam Hetts, who is Global Head of PCS, which is what we'll call it for this session. Welcome, Adam. And we have Sabrina Geppert, and she is our Senior Portfolio Strategist, and she's based here in London. So I thought it'd be worth spending a few minutes just talking about what PCS provides for our organisation, and more importantly, for our clients. So at Janus Henderson, we think we can best help our clients by ensuring that our process is a solutions-based approach, as opposed to a product-led sales process. And PCS is absolutely core to that process for us. So what it does is we provide portfolio insights through custom consultations with our clients using a proprietary analytics engine. And we're product agnostic, but it also serves as an engine to provide our insights and our content to our clients. And we know that's an important differentiator for those clients. And we can see that in the numbers. So since inception in 2015, we have seen, we've analysed over 13,000 portfolios across 4,000 different clients within North America. And then taking on from that success, we've now brought this business across to London, and that began in Q2 2020, so during the COVID pandemic. But we've already analysed over 600 client portfolios through 100 of our clients, both in EMEA and Latin America. And then in fact, last week, we've hired a gentleman called Matt Bullock, and Matt is going to be our head of European PCS. He comes from Wellington Asset Management, where he previously led their multi-strategy and thematics business. And he'll be joining us to really help further our capabilities for our European and Latin American clients. Now, what we've built is based upon the engagements that we have with our clients. And it's really to make sure that we can best help them understand their own fund choices, the asset classes they've invested in, and the weightings of those and how they impact each other. And then we help them understand what those current choices are and how they compare to their existing benchmarks and also to their peers. Now, as I said, it's both product agnostic and objective, but we know that our clients really value that service, and we see that in the data. So for those clients in North America that use our PCS service, we see twice as many net inflows from those clients compared to those who don't. And for our largest clients, we see up to 12 times the net inflows. So we know that it adds value. So overall, we really do believe this is a powerful tool that really adds real benefit to client outcomes. And that's why we're really keen to help push out the service right across the Janus Henderson client framework. So with that, Adam, we've just got through COVID pandemic. Well, fingers crossed that we've just got through that pandemic. I really hope we have. Why is portfolio construction more important than ever today?
Thanks, Will, and I'll match your crossed fingers by knocking on my wooden desk table here as well. But yeah, thank you. My view is portfolio construction always matters, but maybe this year it matters more than ever because of all the fear out there from investors, but all these unprecedented risks, whether it's inflation or variance in the pandemic or low rates or high valuations, and the propensity of those fears to generate these hasty decisions in portfolios. And so I think the real risk that we're seeing in our client consultations is maybe that investors could be their worst enemy in this kind of environment. And so this is where good portfolio construction comes in, because I think the narrative is actually a lot different, and that this year is actually better than ever for investors in a sense. You can just look at the S&P. In the last 3 years alone in the S&P, it's doubled. And that in any typical normal reasonable wealth plan would take a decade to produce. In the last actual decade, the S&P has generated around 20 or 25 years worth of growth for investors in a typical reasonable wealth plan. So investors have actually been through this time machine, and things in that sense are actually better than ever. And I think that puts those risks in perspective. And so this is all about surviving and locking in and preserving those gains. So in fact, our outlook for 2022, we titled A Survival Guide for 2022. And that survival guide really boils down to three key principles. The first of which is the old time in the market, not timing the market. So it's staying invested. And then second would be, as you're staying invested, don't abandon ship and make drastic decisions because of those fears. Just adjust your sails and make some asset allocation tilts, not big trades. And then third, as you're making those tilts, seek out those broad dynamic solutions. Like in any survival situation, those Swiss Army knives that are dynamic and flexible can be the most valuable tools in your toolkit. So that feels like good portfolio construction to us. And because of all those fears versus reality out there, it might be more important than ever this year.
Thanks, Adam. It's a positive story that so many clients have really got returns far better than they ever planned for in the last few years. But as you say, looking forward, you talked about those Swiss Army knife solutions. Sabrina, what does that mean for our European clients?
Yeah, thanks, Will. Yeah, so basically this Swiss Army knife solutions that we're talking about are really what we think every investor should have in their survival kit for 2022. So in EMEA, clients are continuously worried about inflation, interest rates, elevated equity prices, and they really try to navigate and survive through these different uncertain market conditions. So in our portfolio consultations, we really try to discuss which of these Swiss Army knife solutions do work for them and which are suitable. Can we please get up the slides? Perfect. So a great example of the Swiss Army knife solution is basically strategic bonds. So on average, the UK IFA has allocated 22% of his fixed income to strategic bonds. So this is higher than their allocation to government bonds, which might surprise some people, and by far higher than their allocation to the bit more riskier high yield or emerging markets debt. So the strategic bond category really demonstrates actively managing the duration, which we see on the right chart, but also, for example, the credit exposure in their funds. And this really makes them kind of like a perfect opportunistic middle ground between the intermediate core fixed income and the high yield space. I mean, some of our clients are worried about the fixed income, as we just mentioned, but other clients are worried about the equity. In times like this, where both of it might not perform 100% great, we have many clients who turn away from equities and bonds altogether and turn into alternatives. So alternative strategies can look complex in some ways, but for us, it's really important that when clients are deciding to allocate to alternatives in their portfolio, that we are reminding them to follow a goals-based approach. So that basically means matching their intentions with the respective alternative strategy that fits the portfolio. Because this way, really, it decreases the chances of disappointment and hopefully makes their alternative allocation a success. Most importantly, so these Swiss Army knife solutions are really not just brought up by us, identifying the solutions that fit our research in PCS. These solutions are really what we see filling the voids in real client consultations that we see every day globally.
Thanks, Sabrina. And Adam, is that what you see for our US clients? Is it the same approach there?
Yeah, similar approach for our US clients, and certainly like-minded with Sabrina, but just keep in mind in the US, our clients are at a different starting point in their portfolios. We're really focused on a few different solutions in the US. So I can list three. The first would be US all-cap equities as an important solution to address that ubiquitous US large growth overweight in portfolios, which is great for the lockdown, but not as great for the recovery reopening trade. So as we're thinking about that US large growth overweight, keeping in mind what I said about making tilts, not trades, we're not just picking a style box like mid-value or small value, but just drifting that center of gravity for portfolios away from large growth down to mid-blend and looking for strategies that are large, mid, small value growth to get more of that cyclical exposure that's so important in a recovering economy that's also overweight in mid and small cap equities compared to large cap equities. And then similar story moving outside the US. On ex-US equities, the solution we're focused on there is foreign large blend strategies that have international developed value and growth exposure. The clients in our database that have international equity exposure, 80% of them have a growth tilt on their ex-US developed equities. And so similar to the US there, if you have a growth tilt on your international equities, you're missing one of the most valuable benefits of global diversification in your equities, which is that cyclical exposure that comes on the blend and value side. So again, foreign large blend equities is a solution for the global equity conundrum. And then third, on fixed income, for all the fears of the death of core bonds. We don't think bonds are dead. We think they're just having a midlife crisis. So there we're focused on multi-sector bond solutions as a way to move outside the core and generate income, hopefully competitive with traditional high yield levels of income, but without the traditional level of risk you might get in high yield benchmarks.
Thanks, Adam. And you both mentioned fixed income solutions, and perhaps we should go into a bit more detail there. So in a low rate environment with tightening spreads, and then the very real threat now, it seems, of inflation, what are we going to say to our clients about that? Sabrina?
So everyone out there is supposedly worried about the fixed income. I think what's important for us is that all the clients are different. So clients have different concerns, different kind of worries, and also different risk perceptions per se. So in an article focusing on redefining duration in fixed income that our team has published very recently, we actually tried to distill all the client conversations we had over the past months on fixed income and all the worries of the clients into 3 investor personas. Can we please get up the next slide? Perfect, thank you. So the first example is an investor who would aim for high quality fixed income with a competitive yield, but more defense against rising rates. So with most global sovereign bond yields actually yielding low or even negative in some parts of the world, investors really have to look for a new defensive toolkit in their core fixed income, which is still providing substantial yield on the other side. So that's where we think asset-backed securities are actually fitting in. So asset-backed securities are a underappreciated but very sensible diversifier to sovereign and corporate bonds in the fixed income portfolio. And they're really a potential solution for the clients who want to have high quality, but still want to have like a substantial yield in their fixed income bucket. The second investor persona wants to increase yield, but worries about high yield spread levels and is hesitant maybe to add more equity-like risks into their fixed income sleeve. So as we showed on the slide before, UK investors are on average allocated to strategic bonds with like 22%. So strategic bonds share, along with corporate bonds, the benefits of higher yield compared to the government bonds, but also lower volatility and lower losses during equity sell-offs, for example. So we think strategic bonds are really quite an interesting asset class, especially because they have a very low sensitivity to rising rates, which is something that comes up in particularly every client discussions I think we have at the moment here in the UK. So you could say strategic bonds really give the clients kind of like the best of both worlds. And you can really benefit from these funds who are like actively and dynamically managing their different exposures to the different market conditions. And the third and last client example are the clients who really just want to diversify away from equities and bonds into alternatives. So if you're thinking about fixed income alternatives in particular, it's really important to diversify the alternatives that have a very similar risk and return profile maybe to bonds, but still are, for example, less sensitive to interest rate hikes. And that's where we think, for example, we see relative value arbitrage, market neutral strategies, which can be really interesting for clients here. So we think just in any of these investor examples, basically, from a PCS standpoint, we think it's really most important that clients always go for a thoughtful and forward-looking asset allocation process. And that should like align hopefully as well with the solutions and the different goals of the clients.
And I can add some perspective from the US when it comes to fixed income. If we can move over just to the last slide, please. Thanks. And so the same 3 buckets, same 3 personas we're distilling our client engagements into. Different solutions, of course, for the US. So for that persona 1, the clients that want to diversify and lower their duration or interest rate risk, but not give up too much yield. We're thinking about mortgage-backed securities there, MBS. MBS is more of what you love out of the ag, but less of what you hate, and that it has typically higher yield potential than the overall ag benchmark and lower overall interest rate, generally speaking. And then in that persona 2, for clients that want to reach for yield but responsibly, that goes to those multi-sector bond solutions that I already talked about. And then that third bucket, the persona that wants to diversify from stocks and bonds altogether, same as what Sabrina explained, we're taking that risk-based, goals-based approach to allocating to liquid alternatives.
Thanks, Adam. And Sabrina, any other asset classes that we should be thinking about?
Yes, so I think we haven't mentioned REITs so far. So it's short for real estate investment trusts, and that are basically companies who are own and manage properties and mostly traded on the major stock exchanges out there. So we're talking every day with clients about them. And we think they are a great example actually of this Swiss Army knife solutions. So REITs are really a great and appropriate solutions for clients, for example, who are concerned about higher inflation, who want to seek income, especially in this still continuing like low rate environment. And also for clients, I mean, especially important maybe over the last 2 weeks, who want to diversify away from like the concentration of the US growth and technology stocks in their equity portfolio.
Fantastic. Thank you very much. I think what we've covered, global equities, fixed income diversification, goals-based alternatives, and now REITs. So a really useful survival guide for the year going ahead. Adam, any last minute survival guide tips for the rest of us?
Yeah, thanks, Will. We covered plenty, so I guess I'll just go back to where we started, which is don't let fear be your driver. Don't be your own worst enemy. Realize things in a way are actually much better than ever. And I'll just go back to those key principles, which was time in the market, not timing the market, so staying invested. And then 2, as you're making changes, remember just adjust the sails, don't abandon ship, just make small asset allocation tilts, not big trades. And as you're doing that, look for those dynamic, broad solutions. And if you remember, in any survival situation, those flexible Swiss Army knives are the best tool in your toolkit. So I can just leave everybody with a quote from Warren Buffett when he said that diversification might preserve wealth, but concentration builds wealth. And that might be true, but there's been a ton of wealth built the last decade from concentration in portfolios. And I think as markets are transitioning, I think in this season of asset allocation, diversification is going to be key to help preserve those gains and to survive the next year and its volatility.
Well, thank you very much, both of you. I think we'll turn back to Lucy now. I think we have a few questions.
Great to see you all. I'm not sure we've got time for questions, but I love the survival tips, and particularly Adam, hearing from you, don't let fear be your driver. That was one of the quotes of the day. Thanks so much to you all, Sabrina, Adam, and Will. Thank you.